All right, in this lesson, we're going to take a look at the allowance method and how it impacts the income statement. We're talking about all of this in conjunction with bad debt and the allowance for bad debt. And so as we talk about that, we're going to see how that affects the income statement before and after a bad debt occurs. So let's take a look at the allowance method in the income statement. Now, the allowance method requires that bad debt expense be booked at the time the revenue occurs. So what we're trying to do is we're trying to use the expense recognition principle. We're trying to match the expense to what causes the expense. Well, what causes the expense? The sale on credit. And the reason why that causes the expense is that if we didn't make a sale on credit, if we took cash only, we wouldn't have bad debt expense, right? Because none of our customers would owe us any money because we took cash when the sale happened. It's because we did sales on credit that causes the bad debt. So we're trying to match the bad debt expense to what causes it. What causes it is that we actually made a sale on credit. If we'd never made the sale on credit, we wouldn't have bad debt expense and we wouldn't be talking about this allowance for bad debt. So that's what we're trying to do. We're trying to match the expense to what causes it. And so when we find out that a customer can't pay us, that situation we don't use as the bad debt expense. We are going to do a journal entry, but that isn't the trigger for the bad debt expense. It's the sale on credit that triggers the bad debt expense. So that's what we're doing here. Now, kind of walking you through the journal entries of what this would look like from a broad perspective here. Let's assume that you made a credit sale of $10,000 during the month of January on $6,000 of cost of goods sold. In addition, $500 of the $10,000 of sales on credit is not expected to pay. So what the journal entry would look like when you made those sales and the cost of goods sold is we would technically just add one more journal entry for the bad debt expense. So if you look here, when the sale occurs, we would debit accounts receivable for $10,000, credit sales revenues for $10,000. When we make a sale, we always have two sets of entries, the sale and the cost of goods sold. So the next entry here would be the cost of goods sold. Debit cost of goods sold for $6,000, credit inventory for $6,000. Then we can add one more entry to establish the bad debt expense, because what caused the bad debt expense? Well, this caused the bad debt expense. We did a sale on credit. So technically we would have one more entry here. That third entry would look something like this. Debit bad debt expense for $500, credit and allowance for bad debt for $500. The allowance is what we call the cookie jar. So the bad debt expense would be the expense and the allowance for bad debt would be the cookie jar in which we put into the cookie jar. And as we have this bad debt come to fruition, we're going to take the money out of the cookie jar and extinguish that customer's bad debt. So that's what the entry would look like if we were actually going to do it this way. So the allowance method. Now, how does this look on the income statement? So if we look at the income statement here, this is kind of how it would look. So these are all just partial looks at the income statement. So notice, or the balance sheet and the income statement. So if you notice on the balance sheet, I'm reporting my net accounts receivable at net realizable value, which is what we said at the very beginning of this section. So notice how I get to net realizable value of accounts receivable. I start with accounts receivable, the $10,000, and then I subtract the allowance for bad debt, which is $500, which would then get me to net accounts receivable at $9,500. So I'm leaving my books at $9,500, even though we have $10,000 due to us. Why? Because we expect $500 of that $10,000 not to be collected. We don't know which customer, but we know from past experiences that $500 is not going to be collected on this $10,000 of sales. If we look at the income statement, again, looking at it in a partial way, we have sales revenue at $10,000. We subtract cost of goods sold of $6,000 to get us a gross profit of $4,000. And notice that because we made the bad debt expense in the last slide here, we have a bad debt expense of $500, bringing our net profit to $3,500. So when we make the sale, we are booking the bad debt expense and it has an impact on our income statement. So we do have a direct impact on our income statement for that bad debt expense that we have estimated. We don't know if it's actually going to be $500. Now, if we move this forward, what happens when bad debt occurs? So if bad debt occurs, we know that a customer can't pay, what do we need to do? So it looks something like this. At the end of the month, you realize that you were unable to collect $200 from a customer from which you made a sale to during the current month. So this would be the entry that we would book into our books when we find out that they can't pay us any longer. So we would debit allowance for bad debt. So we're going to take the cost or the money out of the allowance for bad debt, and we're going to put it in to the accounts receivable. This extinguishes the accounts receivable, like we've said before in another lesson. So that's what happens here. But what happens to the financial statement after this? So if we look at the financial statement, and what happens here is that if we look at the balance sheet first, we see that the accounts receivable goes down by $200. So now there's $9,800 that's due to us. $200 was written off because that client isn't going to pay us anymore. And you notice that the allowance for bad debt also goes down by $200 because we no longer have that reserve in the cookie jar. And so notice that our net accounts receivable stays the same. So net stays the same because we have put together this allowance jar that we take out to extinguish an accounts receivable. So that's what the balance sheet looks like. If we take a look at the income statement, the entry that we just did doesn't impact the income statement at all. Why? Because we booked the expense when the expense happened. When did the expense happen? When we made the sale on credit. So if you notice here, nothing changes from the income statement. The net profit is still $3,500. So that's what the income statement looks like and the balance sheet looks like after we have a write-off of a debt. Okay, so a couple of things, kind of a results to think about when we think about an allowance method and income statement. When we book an allowance for bad debt, the income statement is impacted on the same day as the sale. So it's almost like we're making a third entry when we make a sale. One for the cost, one for the sale, one for the cost of goods sold, and one for the bad debt if we've made that sale on credit. When the bad debt is realized, we remove the AR and reduce the allowance, but the income statement doesn't change because we already took care of the expense. When did we take care of it? We took care of it when we made the sale. When we made the sale, we made a journal entry for the bad debt expense. Now, in practice, what normally happens is we don't make a third entry after every sale. We just, at the end of the month, total all of our credit sales, and we'll use some type of estimation to make one entry because instead of making 3 entries, we can just make the 2 entries that we're normally doing. And at the end of the month, we can sum it up and then just do 1 entry. It doesn't really change it that much if we wait 30 days to create that bad debt expense entry. So as you go along, you're going to notice that we're not necessarily doing every sale a third entry. We kind of just sum it up. And then in the example, it says, okay, during the month of January, this is how much sales occurred, and prepare the bad debt expense and the allowance entry for this month's net credit sales. And then you would just do 1 entry for the month. So just kind of practicality, what happens, we don't do third entry, but it's like we do a third entry. We just sum it all up at the end of the month and do 1 entry as part of our adjusting entry. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.